Hi folks, thanks for joining us. We have a little talk show that we call Money Talks, and we are here to answer many of your questions about just day-to-day things that come up that a lot of people just don't know where to turn. Well, we've got all the answers here. Our show is called Money Talks, and my guests are from Finer Wealth Management, Michael Finer, Gary Kuhn. Thanks so much for coming.
Great to be here.
It's great to see you guys.
Great to be with you, sir.
There's so many questions. People are completely overwhelmed. So let's just start with the basics. This year, so we're halfway through 2015. What kind of a year has it been for investments?
Well, it's been I would say a slightly up year. Here we are in June of 2015. It's been kind of an up and down year throughout the year, but as we speak, the Dow Jones Industrial Average is up about 1.25 points. So a little bit of an increase.
Better than down.
Better than down, and the S&P is up about 2.5 points. The Nasdaq's done a little better, so stocks have sort of grinded to a little bit of an increase so far this year. Fixed income is a different story. Fixed income is now challenged, and if you've had your money in fixed income, for instance, in a 10-year bond, you actually would have lost money so far in that part of your portfolio. So something to keep an eye on going forward.
What do you think, Mike? Tim?
Yeah, most definitely. The bond market is what's of particular concern this year. The last few months, bonds have lost, 3 to 5% depending on how you're invested. So a lot of people have been surprised by the fact that even though the stock market's been up slightly, that their portfolios have gone down. And that's probably the big theme for the rest of 2015.
We're going to get to that, but first, why? Why did that happen?
Well, the U.S. dollar has been exceptionally strong versus international currencies, and that's really a function of the U.S. economy is much stronger than, say, European or emerging market economies. And the U.S. has been ending its stimulus, where it has been flooding the economy with purchasing bonds and so-called monetary stimulus, while the other economies in Europe have done the opposite. They're starting to flood their economies with currency and provide monetary stimulus. So while we're starting to stop it, other economies are starting to stimulate, and what that's done is caused interest rates to increase. And people see that, I think, every day when they refinance, and mortgage rates have gone up and whatnot.
So the trend, you started to talk about the rest of the year. Is it a trend? I mean, can you predict? Obviously, yeah. Let's hope you could predict so that we'd all know exactly where to put our money. But what do you think?
Well, I think for the last approximately 2 to 3 decades, interest rates have actually been on the decline. You probably remember 1980 or 79, 80, 81 when interest rates were 18%.
Oh man, right.
And now they're 2%. So in a certain sense, the trend has come to an end simply because things really can't go much lower. So most pundits, and I think the economy seems to indicate that interest rates will be on the rise. So that trend, I think, is something that's here to stay and something that's very serious for anyone who has a portfolio to think about going forward. Exactly how fast interest rates rise or how it happens is obviously difficult to predict, but it does appear that the inflection point has occurred and that interest rates will be going up over time.
Let's talk to people for a moment about their homes, about refinancing their homes, about selling their homes, maybe buying a new home, downsizing. I mean, these are all things that I think people are concerned about when they hear about interest rates. So, I mean, is it a good time to sell your house, Gary?
Well, it definitely is a concern now in terms of being able to, when you go for a mortgage, the interest rates starting to tick up because of the interest rates going up. So,
All mortgages? I mean, 30-year, 15-year jumbos and home improvement loans?
They are starting to go up. I mean, as Mike said, historically, you look at some of the rates in the past and you can say, well, okay, they're still fairly reasonable, but they are starting to go up. So that may actually stimulate some people in a way to go ahead and move forward. So if you're selling a home, it actually might help from that standpoint, even though they're starting to go up. They're going to say, okay, maybe now's the time to
So
buy a new home.
Buyers
So-
could be motivated by that.
I think it's definitely a topic that they're starting to think about because home prices are very correlated to interest rates because people are more concerned with their payment in many ways than they are the actual price of the house. They are concerned about the price, but the payment
Right.
is
And the
very
interest rate
important.
is a huge-
It is, and interest rates sort of dipped for 30 years down to 3.5 to 3.75%. Now they're closer to 4% as an example. So you start to feel that in a monthly payment. Like Gary said, it's still very reasonable, but there is definitely a trend where you're probably not quite in the threes anymore and starting to hit 4% and to go that way. So people the conversation has started, hey, maybe we better do something because it looks like interest rates are starting to trend up a little bit.
I mean, and it's not that it's a 0.5 percentage point such a big deal, but I think people hate to feel like they missed out.
Well, it is a good point. When people talk now, they said, hey, I wish we had refinanced at 3.5 or 3.6, 3.7. Now when it's 3.99 or 4%, they feel like they've missed,
Right.
Kmart special or something. So it is a psychological thing that people want to lock in, even if it's not a gigantic amount of difference.
Yeah. So what are you telling your clients? What are you saying to people about where their money should be at this point and going forward?
We still do believe that this is going to be a good year for the stock market, not necessarily a boom year per se in the positive sense, but we started out the year feeling that this was going to be a sort of a mid to upper 1% single digit increase kind of a year, sort of in the anywhere from the 5 to 10% in terms of the value of stock holdings, and then obviously you have dividend income in addition to that. But and we still think, even though, for instance, the Dow is up, as we said, about 1.25, and the S&P about 2.5, that we still believe that we'll be somewhere in that range in the mid to high single digits for the year. So we continue to believe that, and there's some reasons for that. One is that we've seen the energy prices, are more
Right,
affordable
lower, yeah.
for
Even though they
folks.
seem to be inching up too.
They're starting to go up too, but it has been we think a benefit to the consumer,
Sure.
to the costs for manufacturers, and I think we just have become now the number one producers of petroleum and natural gas over
The United
Russia.
States.
Well, that's
So
for
that
the
just-
first time ever.
Right.
That's
I wouldn't say the
remarkable.
first time. I think the first time in several generations. We were in the 50s and 60s, but then obviously the Middle East and other countries. But I think it was just out this week that we have overtaken Russia, Saudi Arabia as the number one producer of
Yeah.
hydrocarbons, basically in the world,
Wow.
which is amazing
It is
compared to
amazing.
where we were.
It is amazing. I mean,
So-
let's take
so
a
we
moment
think-
on that.
Yeah, it's been a great
And it
benefit.
affects everything.
It does. I mean, actually, one could argue that the decrease in oil prices is what's been hampering the stock market this year. Because don't forget, there are oil companies and other companies that are in the stock market. So those companies have actually they're down generally,
Understood.
or they haven't had strength. But overall, obviously, we've had a huge influx of money that's staying in this country because the frackers, the other oil producers, we don't have to import as much oil from other countries as we used to.
Right, and it makes a huge difference just to people.
And
basic
jobs.
consumers. I mean, yeah, we'll talk about jobs in a minute,
Yeah.
but I mean, people are traveling more, they're driving
Sure.
more. I mean, if you ever leave your house, you can't move. The traffic is, I mean, I know there's a lot of reasons for the
Like-
traffic, and that's an entire other show. But, I mean, it's just, people are more mobile. They're feeling more confident. The consumer price index is part of what I think is generating all this well-being among people who are spending money. And it starts with, being able to afford the gas to go to the grocery store.
Right. Absolutely.
Oh, absolutely. And by having that stable inflation that you mentioned, a very very low 1, 1.5%, it makes consumers more confident that they have a better outlook as to purchasing things. There's no
They're not
real.
afraid
Yeah, exactly.
as much.
Exactly.
Yeah. And you mentioned unemployment. It's been down.
Yeah, unemployment is down significantly. In fact, the jobs report came out this morning, and the jobless claims were about the same. And I think last month we created 285,000 jobs. So we created a lot of jobs in the last 4 to 6 years.
I know people always wonder though when those. I know I do when the numbers come out. I mean, does that reflect people who've just given up looking for jobs? I mean, do you feel like that's a really good, strong indication of unemployment in the country?
Definitely not. I mean,
Who wants to take that one?
Yeah.
It all depends on how you look at statistics, right? But you definitely have that factor where people have stopped looking for work. There's no question. But we are adding new jobs that I think is a couple 100,000
And that's a
a
fact.
month.
we're
That's
adding
a fact.
jobs. Yeah, like I said, adjusting it to understand if those jobs are all full-time jobs, if they're good-paying jobs, what part of the economy
I mean,
is adding jobs.
and who are they hiring? That's the other thing.
Right. So, it's like any story, it's a tale of two cities. If you're in the high-tech sector, if you have a lot of skills, if you're whatnot, then jobs are not an issue in this economy.
It's always interesting.
Less
that-
skilled,
sorry.
no, but less skilled is an issue.
It's always interesting to me that number comes out without really reflecting all of the college graduates who are looking for work. I mean, that's got to have an impact on the economy too, right?
Definitely, if you're a college graduate and you have certain types of skills, you have no issue.
And a lot of debt.
Yeah, the amount of debt for college students is over $1 trillion, and that's a huge issue for most students, and it makes a difference on what they pursue and how they deal with it. It can really put them under intense stress.
So what else are we looking for toward the end of the year, the next 6 months? Unemployment, we hope, stays stable. Or
Well, the Federal
continues to
Reserve,
drop?
talking about interest rates, that's something that most people expect that the Federal Reserve is finally going to move off of their sort of zero interest rate policy, and that's been one of the reasons why you've seen, the interest rates of fixed income start to be affected in advance of that. And so most people feel, and I think we would agree, that most likely in the fall, sometime around September, you'll start to see the Federal Reserve, start to uptick on their interest rates. But we don't think it's going to be dramatic and fast. We think they're going to take their time and kind of stair-step their way up over time.
Well, it
so,
would seem silly for them not to do that. I mean,
Right.
because if they a huge increase in interest rates, we're in another. What are we going to call that one? Depression. There's going to be a definite impact on the economy that would not be good. So
And
they're
that
not
is
going to do that.
that's the big question: how they raise interest rates and how little, and how they manage it psychologically. To add some sort of increase this year.
So an increase is inevitable. You think it's
I
inevitable.
think so. I think at least an eighth of a point to a quarter of a point is inevitable. Whether that changes mortgage rates and other things, because don't forget, that's just the Federal Reserve rate,
Right.
and that's really a rate that banks loan amongst each other and whatnot, but it's
But
still...
it affects credit
Oh,
cards.
it does, it
and-
does. It affects everything, but they want to. They just can't, because everyone's afraid. Every time they raise interest rates, the last time they did it, it caused recession. Hate to use...
I didn't
I
wanna
know,
say
I
the
know you
word.
didn't, I know
tried
you
not to
didn't,
say the word.
but every time they do it, they don't time it well.
Right.
So everyone...
We're at a good time
it's,
for a recession.
it's never a good time for
It's not.
raising interest rates.
Right. And one last thing while we're just on this topic of what to look for in the next 6 months. So what's your advice to consumers at this point about what they should be paying off, what they should be buying, how they should be paying for it? Obviously, now's not the time to run up the credit card bills. Not that it ever is, folks, believe me. But, I mean, what's your advice?
Well, it's definitely to start to, if you can, reduce your debt. Obviously, it's good to reduce your debt
Anyway. Right.
But like you said, the credit card interest rates and other things are tied to various benchmarks, and those benchmarks will be going up, which just means that your interest will be going up when interest rates go up, so it'll just cost you more to have the debt. So to the extent that you can reduce that or refinance now while the rates are good.
Yeah, there was a time, I know that everybody thought that it was a really good idea to take out a second mortgage on your home, or a home improvement loan, or whatever you want to call it, at a low interest rate, and pay off all your debt. Because that interest would be less than what you were carrying on the credit cards or the car payment or whatever. Is that still true?
Mathematically it's true, definitely, in that it's a lower interest rate on the house than it will be on a credit card generally, and it's tax deductible most of the time.
Mm-hmm.
That works so long as you just don't run up the credit cards again.
Oh, yeah.
So you have that
Pay off the
issue.
credit cards, that's
Right.
That's
If you kill the
yours.
credit cards and you do that, it's a good strategy. But if somehow that frees up the credit cards and allows you to re-borrow and whatnot, sometimes we recommend that people don't do it, depending on their personality. So there is a little bit of a behavioral personality
Right.
issue that you do
Case
have
by
to consider.
case.
It is case by case.
Yeah.
But generally, it's a good idea.
Gary, you want to add anything
Yeah, I
to that
think,
before we move along?
Yeah, just from an investment standpoint this year, a little bit different. The last couple of years have been the years to be in the United States, and we still think that's the case, as opposed to in international investments. We're starting to more look into the international now, because we feel that they're starting to stimulate in Europe, it's, for example, on their monetary policy, and start to build and get out of their recessionary situation. We think that presents some opportunities. So again, the last couple of years, really the U.S. has been by far the strongest place to be, and we do think that'll continue to be the place this year. International is an area that we're looking at.
No need to move to Switzerland.
Well, unless you like the chocolate or the skiing.
Leave it to you to bring up the chocolate and the skiing. See, Gary and I are just,
I know, I know.
we're just
It's-
talking about it.